Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. Very chilly morning here in Pretoria, but good to see so many of you online again. We have a lot of ground to cover this morning, so we'll get right into it. And it's my absolute pleasure to welcome two phenomenal fund managers for the first time on Boutiques on Wednesdays. We're joined by Bruce Thistlewhite, Managing Partner and Portfolio Manager at Oakhaven Capital. If you remember right, last week, Wednesday, Corian also made mention to Oakhaven Capital. Bruce will give us a short introduction to their business and discuss CPI plus 5 versus a steep SA yield curve and what that means for income funds or credit funds. Bruce will be followed by Philip Short from Flagship Asset Management, looking at what American dynamism mean in context of investment opportunities. Good morning, Bruce and Philip. Thank you so much for joining us this morning. How are you doing?
Good morning. Very well. Thanks, Eugene, and yourself.
Really great. Thank you.
Thank you.
James, looking forward to your presentations, and I think the audience as well. You've been in existence for a very, very long time, so maybe new to the audience, but you're definitely not new to the investment world. Bruce, you up first, so you can start sharing your presentation. Philip, if you could stay online for us, and you can start presenting as soon as Bruce is done. To our audience out there, you know how it works by now. After both presentations, we'll take a couple of questions. More than welcome to post questions in the Q&A bubble.
Okay, thanks, Eugene. I presume you can see this.
Not yet. Not on my side. If you can maybe just share. Let's see. I just want to check. Is it just me that can't see the presentation? Can you see it on your side? Yeah, it's coming through now.
All right.
Yeah, got it out.
Thanks very much.
Fantastic. Thanks, Bruce.
Okay, so Oakhaven Capital was established in 2012. The two principal partners in it, myself and Johan Ruiz. We were on the sell side at Standard Bank for 12, 13 years and started Oakhaven in 2012, as I mentioned. So we've been going for 13 years, and this is the first time that we're presenting to yourselves. And thanks so much for the opportunity. So if I look at, we basically started off as a hedge fund. We got a qualified hedge fund later on, which is now been going for 13 years. We then realized that we could branch out. We're a boutique fixed income house. And we then realized we could branch out into the income space as well and into the bond space. I think what you find is a lot of the small boutique managers, because of their skill from overnight all the way through to 30 years, can actually enhance the yield on some of the bond funds and the income funds. We don't specifically focus on a money market fund, and the main reason is because we think that the amount, just because you can trade on the day versus getting almost a 1% yield pickup on an income fund, it's actually more beneficial as an investor to actually go into an income fund with that T+1 trading. Why you should listen? I think we've performed pretty well on our income fund, and we got a 5-year Raging Bull Award in 2024, and we got the 7-year Citywire Award for bond funds. Now the thing about Citywire actually don't define between the funds. So what they do is they just go, if you're an interest-bearing fund, then you go into their award. So for an income fund actually to outperform a bond fund is also pretty special from our perspective. So we have a focus. Historically, we've been very institutionally focused, hence why we've only just sort of coming now sort of to the fore to the DFI side of the business. We continue to grow our core income fund. We've got a bond fund that's coming up to 5 years, and we're looking to start a core income fund, a dollar-based core income fund. We don't necessarily want to place dollars into a rand fund because we believe that the investor would like to make that choice, so that when you look at the underlyings, you can then decide, how much rands exposure do I want, how much dollar exposure do I want, and that's why we specifically would look to have a separate fund from that perspective. So as I mentioned from ourselves, you can see there that the returns are pretty commensurate with the bond return. So, here I've shown you the all bond index in green, and you can see what our fund index did. Much less volatile return, but giving you quite a decent return at the end of the day. And then obviously according to wherever Steffi and the inflation index have been over that time. Just to point out that our fund has returned CPI plus 4%. And the reason I'm referring it back to CPI is because we're going to be talking about CPI today a little bit. And then obviously it's outperformed the Steffi as well from that perspective. I think it's when you're looking at income funds and interest-bearing funds, I think there's just a couple of things to bear in mind, because there's a multi-asset income portfolios which can hold up to 10% offshore equity exposure and 25% local property local exposure. So there is some equity involved in those multi-asset income portfolios. Then, according to ASISA, you get your interest-bearing portfolio. So you'll get a variable term portfolio, which is generally your bond portfolio. There's no duration caps. Then you get your interest-bearing portfolio, which is your short term, and that has a maximum underlying interest rate risk of 2 years. So it's identical to your variable term from an investment perspective, but it's capped out at 2 years. So your interest rate risk is a lot lower. So your volatility will be a lot less. And then you get your interest-bearing money market portfolios. So if we look at the multi-asset and we just look at what funds have been attracted into the multi-asset income funds, you'll see that there's over 400 billion of funds into the multi-asset income funds. And of that 400 billion, you can see 250 billion is sort of into debt instruments. The rest of it will be into equity instruments. And when you look at it, it's sort of a reasonably fair split between corporate debt, government debt, and financial institutions, mainly your banks at the end of the day. When you look at the actual interest-bearing categories, which will be your short-term and your variable term funds, so you can see there on the left-hand side, you can see that your variable term, on the left-hand side, which is your income side, you'll see that a lot of it is institutional funding. So one of the things that we've picked up from the investment scenario now into income funds is that they're still very skewed towards banks. And I'm going to show you later that in actual fact, you can get a better return on government paper. So if you look at our fund at the moment, our fund is almost 95% government paper at the moment, because you can get a better return on government paper than you can on bank paper. And then also you can get a better return than on corporate debt. And I'll show you why we don't invest in corporate debt at all. Because we think corporate debt, there's a big liquidity play to it. And it's very difficult. Corporate debt is one of those things that, if you want to sell it, you can't just leave the theater. You've got to convince somebody else to go into that theater when it's on fire. So we don't particularly like corporate debt. We do believe there's a space for it, but we don't trade corporate debt in our fund. Then on the right-hand side, you'll see that there's your variable term funds, and you can see it's mainly made up of obviously government paper, and that's why you get a little bit more volatility out of that, because of the duration all of a sudden that you're putting onto your books at that point in time. This is the investment universe in South Africa for interest-bearing debt. So you can see that on the left-hand side, you can see that it's predominantly made up of government debt, and in actual fact, you could argue that the governments are actually crowding out the rest of the market in South Africa. And this is obviously since COVID, and we've expanded our debt to GDP ratios so substantially. But just to point out from that perspective, there is 15% corporate debt, there is bank debt down here, 36%. There is also then 23% SOEs, and then there's credit-linked notes and structured notes. We advise people to be very cautious when you see that there are credit-linked notes and structured notes in portfolios, because you need to just make sure that those are being marked to market correctly through the JSE. So here's a graph of why we invested in government debt at the moment. So you can see where government debt used to be. It used to trade at JIBAR plus 50 basis points. We're now trading at JIBAR plus 150 basis points. So in actual fact, being invested in government debt is less risky, but it's giving you a greater return. And that's why at the moment, and I'm comparing it here to bank senior debt. So it gives you a better return than bank senior debt. Normal NCDs and that would be trading even lower. And then where you can see where corporate debt is trading at the moment, AAA and AA corporate rated debt. So that's why we actually, why we're holding government debt at the moment. So in the past, we have invested in 80 banks 80 alternative tier one capital. We were investors up here on the left-hand side when it was trading at around the 460, 470 mark. Obviously, we then did go through COVID, and the Reserve Bank was very proactive in stabilizing the market and bringing out repos to make sure that there was facilities in the markets and that. And what you've then seen since then is that there's been a massive compression in these alternative tier one instruments. We no longer hold them. We think that down here at 260 over, we think that they're very expensive. These are perpetual instruments. And the reason we don't hold them is not because we think banks are going to default. It's just because we think that there's a better investment prospect out there. And that investment prospect that I'm going to talk to you at the moment is obviously inflation-linked bonds. So if we look at inflation-linked bonds, the Reserve Bank wants to try and get a real rate of return of repo plus 2.5%. Historically, that's been 1.5%. At the moment, we feel like there's a great investment opportunity because we don't think that this gap is going to last. So we don't think that, you got the repo here up 725 and you got inflation down at 2.7%. We think that obviously at some point in time that we get a compression back between those two. And when we get that compression, that's at the point at which we would then be able to realize some good mark-to-market gains on our portfolio. So the important thing here because lots of people have spoken about inflation-linked bonds on these sessions, I've noticed a couple of discussions about them. And it's important to note that inflation-linked bonds really haven't done much from 2015 all the way to 2020. You can see here that there's small little mark-to-market losses year on year, which ultimately means that your little gray bars, your returns on your gray bars haven't been really good. Now, the reason for this at the end of the day is over here you can see that you wouldn't want to buy these inflation-linked bonds down here at 2%, 1.8%. And so what happens is when you buy, they work the same as a nominal bond. You want to buy the yield high and you want to sell it when the yield is low. So at the end of the day, what you can see here is the return on the inflation-linked bond index. You can see it's been flat over those periods that I referred to. But at that point in time, what's happened is your yield to maturity has moved from 1.8 up to 4, up to 5%. So one of the key things here is entry is key. If you entered into these inflation-linked bonds down here, you've made losses. Your carry's been very, very bad on the portfolio. But your entry is key. And we believe up here at 5%, if you consider that some of the most aggressive equity funds would like to give you inflation plus 5, and what we're telling you is you can go and buy an inflation-linked bond at inflation plus 5. And that's why we like it. And that's why we've moved our portfolios from alternative tier one equity through to inflation-linked bonds. So when we talk about it now, there's probably a discussion to go, well, if we think that that's good value, why don't we just buy nominal bonds? So we've got to understand that, as I have explained to you, nominal bonds do come with a lot more risk than inflation-linked bonds. Inflation-linked bonds are obviously linked to inflation, which is sort of a variable rate. And we know that the Reserve Bank targets inflation. So they want to bring that real rate back down to 2.5%. But in South Africa, we got a steep yield curve for a couple of reasons. And that's because the Reserve Bank can't cut much more than where they are at the moment because the Fed is down at 4.5%. Our 10-year versus the US 10-year is at decade lows. And also to bear in mind that the US has got 7 trillion maturing this year. So that's a lot of bond funding that they have to do over the next year. And all of that is their bond maturity, which they have to go and refinance. Another contentious point, obviously, is the 45% offshore allowance. And what this means is the marginal buy in South Africa has moved offshore. So we know that the JSE is really struggling, and we know that South Africa's bond market has got a very steep yield curve. And that's because a lot of people have moved their money offshore, have taken their full allowance offshore. And the problem with that is that we haven't created an investing scenario where actually the foreigners have decided to come into South Africa and pick up the slack of all the locals moving offshore. So again, that's created the structural steepness in the yield curve, and also the fact that the inflation-linked bonds are trading where they are. This is simple demand supply, and the demand unfortunately isn't out there, but the supply is. And then National Treasury, it's, they keep on promising that their debt to GDP is going to curtail in 3 years' time, but they never seem to get to that point. And they have chosen consumption expenditure over investment expenditure, which is never good from an offshore investment perspective. CPI target is probably going to get lowered to 3%. We think there's a little bit of reluctance from National Treasury, and Gordon Guana, our Minister of Finance, the other day came out saying, well, he's still going to wait and see what the paper looks like. It almost looks like the Reserve Bank's trying to fight this through the media now by actually telling the National Treasury that a lot of the sacrifice ratio has already been taken up, and so they feel that this is a really good time. And then the last thing that's really on our mind is the municipalities. We worry about municipalities. They're running out of money, and they're using Eskom to fund themselves. They're not paying down their debt. And because they're not paying down what their use isn't even debt. They're not paying down Eskom. And that has a massive impact on service delivery. And we do worry a little bit about the social stability in South Africa based on the lack of service delivery. And that's it. I think I'm done.
Bruce, thank you very much for that. If you can maybe stay on the line, we are going to take some questions afterwards. Philip, you up next. You can start sharing if you're ready.
Let me know if you see it.
Yeah, perfect. Got it. Thanks, Philip.
Okay, great. Thanks to Bruce for that as well. It was quite insightful. So we've been hearing the term quite a bit recently about American exceptionalism and if that's coming to an end. So I've been thinking about that sort of idea lately in terms of asset allocation. I thought, when I was thinking about it, let me first read up exactly what is meant by American exceptionalism. What does the exceptionalism refer to? Is it the US that's a great country, that they've got the best economy, or that they churn out the best companies? And interestingly enough, there wasn't like consensus from all the papers that I'd read from that. There wasn't a common denominator in terms of what they're referring to. So I borrowed the term American dynamism from a prominent US venture capital firm, Andreessen Horowitz, in coming up with this idea. And I think it's a lot more descriptive in that it means that America is dynamic, that they can show progress, that they can adapt, and that they can create. If I think about America, just like from a country point of view, they had a bunch of very adventurous people who sailed over on the Mayflower from the early 1600s from the UK, and you had the cowboys to the California gold rush, to the first skyscrapers, and to the atomic bomb. They've invented most of the modern day stuff like the light bulb, electricity, the airplane, the television, transistor, microprocessor, and now AI. So that was my thinking in terms of American dynamism. So let me kick it off from there. So what are the traits that lay sort of the foundation for American dynamism? Individualism. So there's accountability and risk and reward, which sort of provides this ambition and incentives that you get mainly in America, and in some countries not at all. You get liberty, so there's freedom of speech and protection of private property. Extremely important when you want to be making money for yourself and being dynamic, that you can retain that asset. And innovation, which leads to technological advancement. An interesting comment I read recently, or phrase from Jeff Bezos, was the key reason why the USA has so much entrepreneurial success is that the country has the best risk capital, which is the key term, where founders can raise $50 million even if their business has only a 10% chance of succeeding. In other words, the US has the most developed venture capital market, and successful venture capital firms understand that out of every 10 investments that they make, that they can lose all their money on 9 of them, and in the other one, it'll be a home run, and it can be such a success and make so much money that it makes more than compensates for the 9 losses that they've made. So then I was thinking, with this this vis-a-vis American dynamism, what does American venture capital market look like? And it's looking like it's still in a very good state. 1 in 6 companies in the S&P 500 were venture capital backed prior to listing or IPOing. These same companies, and it's all these companies that you see here and more, have been outsized performers, meaning that these same 1 in 6 companies actually make up for 50% of the S&P 500's total market value. So if there's no VC or venture capital in the US, it's likely you'd have no Amazon, Apple, Meta, Microsoft, Google, etc. In other words, you'd have no Magnificent Seven, which is a big statement, and it shows you where this breeding ground for American, as I would say, dynamism comes from. The US, by a wide margin, is the largest VC market in the world. You can see the likes of Europe and China growing, but even if you combine Europe and China together, they're still less than half of what the US is. And China and Europe actually have their own idiosyncratic reasons why they aren't successful, or not successful, but why they aren't as large as the US when it comes to VC. The US has nearly half the world's unicorns. A unicorn, by definition, is a startup with a valuation of over $1 billion. It's private and it's not listed yet on any listed market. And you would expect to see these unicorns coming to the market, being listed, and where we would then be able to have access to them in our global funds. So you can see on the left there, the US has nearly 4 times, or approximately 4 times the number of unicorns than China, and 6 times versus that of Europe. So accessing US dynamism in our global portfolios, there's just a couple I've highlighted here. There's obviously a lot more that I didn't have time to include here. But if we start with AI, which has its roots and is a result of American dynamism, it would be easy to start here with a list of, saying, NVIDIA or Broadcom. But if we take it 1 or 2 steps further, and we think, okay, artificial intelligence needs data centers because it needs a vast amount of data to crunch to feed back into the AI model. And as it stands today, there's currently more data centers in the US than all the other major countries combined. Okay, so this is it's quite an advantage and head start that the US has. Now, data centers are extremely power hungry and they need a lot of energy. So the next slide I'm going to show you is the incremental number of data centers that are expected to be built in the US over the next 5 years versus the rest of the world, and more specifically, the energy requirements that those incremental data centers would need. So if we look on the left-hand side, the number of new data centers that are going to be built in the next 5 years are going to require 17 gigawatts of energy, and the rest of the world combined new data centers will require 7 gigawatts. So to put in perspective, 7 gigawatts is equivalent to the energy demand of 3 New York cities. So it's just put into context how much energy, what a game changer AI is. It's not just in these chat bots that we're seeing or in the data centers, but actually the energy requirements that we're going to need. And then this gives us ideas and for areas to look for in terms of investments. So one of the investments that we've made last year, EQT Corporation, which is an American natural cost producer, old company, but this new sort of ecosystem of AI data centers gives American companies, dynamic American companies, the opportunity to grow again into this new market, which have done successfully. A private company which I find quite interesting is Helion Energy. It aims to develop, it's still a startup, and it aims to develop fusion power, which provides clean and limitless energy. That's sort of the holy grail. That's how the sun is powered, through fusion power. This is also backed by VC, including Sam Altman, who himself is the founder of OpenAI, a very important company. Sam Altman calls Helion the most important company in the world. So just to give some emphasis in what we're dealing with here. Now, at some point, this company is going to list in the public markets, and it's something that you want your global funds and global funds like Flagship to be able to have access to. Each circle here is a unicorn, and just in the tech sector alone. So it shows you the big pipeline of very large but still private companies that are still going to list on public markets within the next 7 years. VC funds usually list their investments within about 7 years. So this shows you that, within that green US market of unicorns, there's still lots of potential for us to have another MAG 7 or another MAG coming out there over the next 8 years. And you can just see the sheer size of the US versus China and EU. So we think, we're not saying that one must have all your money in the US, but you should certainly not be ignoring the US, because we can see that the US will continue to have a disproportionate size of investments that you can invest in terms of American dynamism. And then just the last slide, just a bit on who Flagship is. So we're a specialist global manager. We have 3 funds, a worldwide flexible fund that Flagship manages, a worldwide flexible fund of fund that we source the best global equity managers, and then more recently, a global equity fund that we manage. The first fund that Flagship launched was in 2001, so we had a long track record, and that was, the worldwide flexible fund that Flagship manages. So that's got a 24-year track record and has outperformed its benchmark since then. In 2003, we launched the International or Worldwide Flexible Fund of Fund, and we've outperformed our benchmark since then as well, so a long track record. And the Global Equity Fund, which we have recently relaunched in August, which is beating its benchmark ACWI in the last 8 months by 5%. So a very good track record across the 3 funds. And I think this is the difference between us and your ordinary SA fund manager who first started investing funds in the local markets, and then later in their timeline, they ventured into global markets. So very much in our DNA. Long-term track record, and fortunately enough to be one of the most awarded boutiques in SA. And that is it, Eugene.
Philip, thank you so much for that. Insightful indeed. I want to unpack your funds a little bit more for the audience. We do understand your views. I mean, you've made it explicitly clear that you are a global specialist indeed. But maybe if I can start with you on your worldwide flex mandates, and I need to understand the difference between the fund of funds and the fund a little bit more so we can unpack that. But before we go there, I mean, worldwide flexible mandates, we know you can invest 100% SA, 100% global, 100% cash, 100% equity. So you've got full flexibility. Let's just maybe start with the geographical or regional asset allocation of your worldwide flex mandates. I mean, being a global fund manager, does it mean that you will predominantly focus on developed markets like the US, Europe, and maybe a little bit of Asia, and not necessarily incorporate a lot of SA in the worldwide flex funds?
Correct. Through the cycle of the fund, we've had very little to zero exposure to SA. I think if you want exposure to SA, you got lots of good, competent managers that you can invest in South Africa. At the moment, we only have 1 stock that is in that fund, which is a South African fund. A South African stock in that fund. And we started that off at a 2% position, but it's grown to be organically to about a 10% position. So that's done really well. But you should expect us to underperform when SA does really well. Outside of SA, we look globally and we look everywhere. So we really take a top-down and a bottom-up approach. A while ago, we had quite a bit in Latin America, but that's come down to about 0. We are 50% invested in the US. We're about 20% in Western Europe and UK. We have, about 4 months ago, upped allocation to Japan to about 67% to Japan, and then about 5 to 6% in China.
Let's talk about the differences between the two funds, both in worldwide flexible category. But as you mentioned, the one is a fund where you actually do the security selection. The other one being a fund of funds. Why both?
Yes, so the one started, the single manager one that we manage, that was launched in 2001. And we started off as a family office here in Cape Town, Flagship. And then when the family offices wanted to put more of their money into the Worldwide Flexible Fund, they thought it'd be prudent to keep the money in-house in Flagship, but not to concentrate all their money into one fund. So the idea was to have a fund of fund and to have all the external managers to be global equity managers, and where there's a asset allocation component that is managed by Flagship. So about 80% of the fund is managed by global equity, international global equity houses. None of those funds are internally managed. So you will find like a number of funds will invest in their own funds below that. We specifically don't do that because we wanted the diversification element. And then we will invest tactically, maybe in some fixed income and gold bullion and cash on 10 to 20% of the fund on a Flagship level.
I want to stick to your comment on gold at the moment. I mean, gold price is soaring. And the question is, do you take profits now? Because, I mean, you've had a good run, or can gold prices just push further ahead?
I think they will push further ahead until there is a new substitute for a risk-free world asset. That status was held by US Treasuries until about 2022 when Russia invaded Ukraine. And I still find it quite interesting. I don't think I've heard anyone say it out aloud, but the US has defaulted on their debt of late. When there were sanctions on Russia, the US and the West froze Russia's holdings of US debt. Now, even though they're willing to pay Russia's debt, they have frozen it, and they've not paid the interest, and they've not allowed Russia to sell that US debt. So they're willing, but they're not able to use their debt. And in my eyes, that is a default of US debt. And we've seen it. And it's not just a coincidence, but when they all lined up together, when the stars aligned, it gave us really high conviction to go high into gold bullion, is that you had the negative relationship with US real rates and gold price de-link on Q1 of 2022, shortly after the invasion. After Q1, you saw central banks buying a lot of gold bullion, almost double the amount of the previous decade. And at the same time, you saw any Russian allies or close friends to Russia either start selling or accelerate their selling of US treasuries. So that all pointed to us to that US has taken over the status as the risk-free asset. And because you can't value gold, it's hard to say when it's expensive, when it's not expensive. So we like to look at it on a relative basis. So if the US somehow manages to become the risk-free asset in terms of its US treasuries, or if another asset becomes the dominant risk-free asset, until that day, our view on gold will stay bullish.
I'm going to talk to your global equity fund a little bit more. And maybe just for the audience, I mean, you didn't put it up, and I actually mentioned it before we came on live. I mean, you've got numerous accolades, Raging Bull Awards. It probably wouldn't fit on one slide. That's why I didn't include it. But I mean, Flagship really have a phenomenal history in managing global assets. On your global equity fund, your benchmark is the MSCI All Country. Most equity funds or global equity funds we're familiar with is the MSCI World, which excludes emerging markets. You purposefully included emerging markets, an all country index. Just quickly, your view on emerging markets, something that one should consider or having more exposure to. How do you manage that in your fund?
It's a very topical point at the moment, and I think it's important because historically emerging markets center around China. And if China did well, a lot of commodities-backed companies you could say would do well. So China, our signal for a healthy China is looking at the bond market. The 10 and 30-year bonds are looking very, very weak that means that yields are very, very low, which is pointing to very weak consumer demand. And in an opaque data sense of the word, the data you get out of China is not always accurate, but at least I think bond pricing would be very accurate. We're not very convinced on a big rebound in China. I did see retail sales were positive earlier this week, but if you look at the amount that equities makes up a portfolio of Western investors, that's disproportionately high relative to China, where property is very high, and the property market we know is not doing well in China. So that makes net worth pretty low as well. So we do have a bit invested in China. And because of China being depressed, you've had neighboring countries, sort of Vietnam doing really well, Indonesia doing really well, South Africa with its own issues. I suppose in short, what I'm trying to say is you can't blanket emerging markets just as an EM anymore. And we look at opportunities on a uniquely one-by-one basis.
You briefly touched on things like US debt, but it seems to be a going concern. I mean, especially if you look at the fallout between Musk and Trump about the big, beautiful bill, policy reform, tax cuts coming through. Some say that will push the US over the brink. Their debt is just going to reach new extreme limits. I think Trump sees it differently. He says, but if his tax cuts, corporates are going to do better, so they're going to collect more revenue from corporates. I think time will tell. Just your views on US debt in general, and there seems to be more concerns if you look at where people start to invest or global equity funds, and people starting to diversify away from the US more to Europe and some of the other markets that you mentioned already. Any concerns from your side on the US? Are we going to see another big crack?
Again, a great question, and I like to bring up sort of interesting stats to highlight the severity of certain things. So this, for example, for the first time ever in early 2024, America was at the point where they had to issue new debt just to pay off the interest on existing debt, not just on the principal and the rolling debts. And the analogy of that is that if it was me and you, and we had a credit card and we maxed out that credit card and our salaries couldn't pay the interest on that first credit card, we'd have to get a second credit card to pay off the interest on the first credit card. And that's a red flag situation. And that's where it sort of becomes unsustainable, is because you have to issue new debt, not just to pay the principal off an old debt, but on interest on the old debt. So that was a tipping point for us. Interestingly, that there's a point where equities will still do pretty well in that environment. There's also, in a mild inflation environment, equities will still do well along with commodities. Yeah. But the current administration's view is that if they can grow the GDP faster than the debt, that they'll be okay. And there's some truth to that. I mean, if you have a GDP they're currently at 130% debt to GDP. If you can grow that denominator, your GDP, faster than your debt, then you've got more assets that you can use to pay off your debt. That remains to be seen. Right now, we are in an area where investors should be concerned. But they're not the only ones with problems. Japan's at 230% debt to GDP, although the asset side of their balance sheet is much stronger than the US. So their net liability to GDP are both about 130%. Italy is also at 130, 140%. I think if America has a problem, it's going to be a problem for the whole world. But this, I think, in one answer, this is probably the best time to be diversified. You do not want to be taking concentrated risks. You want to be diversified in positions, sectors, and geographies.
And I mean, I can see that in all your funds. If I look at the Worldwide Flex Fund, the fund of funds, as well as your Global Equity Fund. Bruce, I did not forget about you. One last question, Philip. I'm going to take one from the audience. What are your thoughts on earnings growth for US tech companies? and the likelihood of AI capex slowing and downgrade of earnings revision, especially with high multiples. If you look at PE ratios of US tech companies, where are we going with this?
So earlier this year, starting in Q1, we already had an earnings downgrade coming in the S&P 500, which mainly came from the tech side, of about 5%. So I think we've already entered some sort of earnings estimates downgrades. Earnings estimates, and this is sort of crystal ball stuff, so it's not to be taken at 100% face value. What we are entering in H2, I believe, is going to be tax cuts at the US level, probably in Q3, which is going to be a boost for earnings. The tariffs that we've had, the annualized tariff rate is around about $300 billion. So this is what the US fiscus is taking in. The total corporate tax income for FY24 or calendar year 24 was $500 billion. So the US with the tariffs can subsidize quite a lot of corporate tax cuts in H2 of this year. So that's something to look out for on the positive side. If we get through the next 2 or 3 inflation reports with subdued inflation prints suggesting that tariffs have not had the negative effect that we expect, we're going to see the rate cutting cycle coming in H2 as well. And this is going to be very beneficial for all companies, including tech. It would probably, the inflation print is something that we're just keeping an eye on every month. Valuations are not cheap. So if we do get the earnings upgrades, even if it's just from a tax cut, even though it's a once-off, that will boost markets.
Look, I've got 40 more questions for you. There's so much to unpack here. But Bruce, if I could maybe step over to you and just look at the Oakhaven core income fund that you spoke to as well. Maybe just to recap for our audience, I mean, the fund is in the category of SA interest-bearing short terms and not the typical multi-asset flex income funds that we deal with mostly on a day-to-day basis. Let's just look at, comparing the two categories. I mean, you cannot exceed average duration of 2 years. And if you look at what bonds did or govies did over the past 12 months, is there ever a point where you think, if I had the mandate, I should have had more duration in the portfolio? I know you've got the bond funds, so if clients want to pick up more duration, they can go there. But do you maybe see this as a drawback on the fund, that your duration can't exceed 2 years over the past 12 months, but more so over the next 12 months?
Yeah, so I think if you look at the Albi at the moment has got a weighted average duration of just over 5.5 years. So if you want 5.5 years worth of interest exposure, you go into an Albi fund. And what that actually means is that for every 1% movement, you're going to make 5.5% during the year. So that's more or less how the average duration works. So if the bonds are trading at 10% and they go down to 9%, your bond fund's going to return 14.5% that year. That's why bond funds have returned 21% the previous years, because bonds rallied 2%. So that, they made 10% on accrual and they made 10% on mark to market. So we don't think that there's going to be a big outplay in nominal bonds, and it goes back down to the fact that the marginal buyers moved offshore in South Africa. Again, it's a simple thing. Do you want to earn 10% in South Africa, or do you want to earn 4.5% in America in US dollars? So we think structurally what's transpired is because the local investors offshore has moved offshore, we don't have that marginal buy in South Africa, and this has taken place on the JSE as well. So on our income fund, though, so we at 1.9 years at the moment on our income fund. So we've taken our duration almost to the max. And what you'll find is the income funds, generally most income funds will buy bank paper linked to JIBAR, and they'll have a weighted average duration of 45 days because it's a rolling portfolio. they actually don't use that facility of up to 5 years or up to 2 years duration. So on our side of things, we actually use that duration, and we look at the interest rate cycle, and based on the interest rate cycle and where we believe that there's a good opportunity, we will go up to the 2 years. So we actively trade that 2 year that 2 year limit.
You did this demystify ILBs indeed. I mean, we see some ILB exposure in some of the income funds, but not a lot. In your core income, you're sitting roughly at about 58%, and correct me if I'm off with that number. So it's a very high exposure to inflation-linked bonds. What can investors expect from inflation-linked bonds on average over the next 2 to 3 years? Putting you on the spot.
No. So we're very comfortable with the position. We've got a theme in our mind. CPI plus 5 is a really good return.
Olga, just checking quickly. Is it me that lost signal or Bruce?
I can hear you. You did go away for a while, but I can hear you.
Yeah.
So we dropped off for a short space there. So we're very comfortable with the inflation link exposure, and that's and even if the Reserve Bank reduces, if National Treasury actually reduces the target down to 3%, we think that that's going to be a really good kicker. We don't see a lot of, we think maybe in the 2 to 3 to 5 year nominals, you can maybe make a good performance, but we don't think that performance will be higher than the performance on inflation-linked bonds. But we still think on the back end, we still worry that the back end won't rally as much as the market anticipates it's going to rally. The easy money's already been made on back end nominal bonds. It's if you make any money now on the back end nominal bonds, there's sort of a little bit of fluctuation that you're going to have to expect.
Bruce, you briefly touched on global bonds. We know there's no global bonds in this fund. You're thinking of creating or launching a global bond fund. Just quick thoughts on global bonds, and more specifically US treasuries. Is this a good time to look at things like that, almost as a hedge or diversify portfolios?
Yeah, so to a certain extent, I agree with what Philip said. That the US has got a lot of debt issues, but bearing in mind that that's 120% of their national debt, or debt to GDP. I think what you've got to look at is will Trump get his way? And I presume at some point in time, Jerome Powell won't be around much longer. And rates will be cut. They get a lot of their funding on the very short term of their book. South Africa's actually got quite a lot of duration from an emerging market perspective on their books. And so what will happen is what Trump would like to see is he'd like to see all of his treasury bills refinanced at a much lower rate. So I think Jerome Powell will see out his term, but after his term, we'll get a much more dovish Fed in, and from that perspective, you probably find that maybe there is room in the 5 years and that, but bearing in mind, low interest rates on the front end, what you will expect in the US then is a steeper yield curve because of the amount of debt that they still have on their books.
All right, very interesting indeed. Bruce and Philip, thank you very much for this. The clock caught us. Like I said, there's a lot more here to unpack. To our audience, Oakhaven Core Income Fund, available on most big platforms, as is the Flagship funds. If you want more information, please get in touch with us. We'll put you in touch with both Bruce and Philip if you want to know more about their funds, or speak to any of the BCI team members. More than happy to provide you with more information. Both of them moving to the BCI stable. So you'll see a lot more of these funds and both Philip and Bruce in the near future. Gentlemen, thank you so much for your time this morning. It's always great to have you with us. And like I said, we'll definitely keep conversation going in sessions to come. Thank you so much.
Thanks, Eugene. Cheers, Bruce.
Cheers.
Right, to our audience out there, quick reminder before you go to next week, Wednesday. Tomorrow, we've got another session on hedge funds, and we've got AG Capital and Terabith to talk a little bit more about hedge funds and what their views are and the different strategies. Always very informative. The session will be moderated by our Chief Investment Officer, Tavunga Shavize from Apex Investment Consulting, and it is definitely going to be worthwhile looking at that. We'll see you tomorrow morning for our hedge fund session. Otherwise, next week, Wednesday again, back for boutiques on Wednesdays. Thank you all for joining, and thank you for your continued support. Always grateful. Thanks.